Hey, everybody, this is Chris Miles here, cash flow expert and anti financial advisor. Hey, I'm going to welcome you out today because I am excited to be able to share with you something that I've had many people just absolutely love. And this is something that I've been teaching over the last really years, but really the last year, I've really helped many people be able to implement this and make this work where you can get money working for you twice, not just doing one thing, but getting it to do two things at the same time. Because who doesn't want more leverage, right? I mean, how many of us want more leverage? We want to create more with less. And that's exactly what I'm going to share with you today. So I'm excited to share this because I know it's going to make a big impact, especially if you really, truly not just hear it and understand it, but implement it. When you make it work, you realize that you're leaving money on the table and you've probably done it for years and you wonder why somebody hadn't taught you this years before, which I've heard dozens and dozens and dozens of times. So I want to talk about really like how I truly make this kind of thing work here. So, all right. So we're going to talk about today about acceleration, not accumulation, because the one thing I teach when I teach with Money Ripples all the time is that I want people to create acceleration. If you want to truly create real wealth and real financial freedom, you can't do it accumulating money the same old way you've been taught for years. I know because I started out being the traditional financial advisor about 16 years ago. I remember back in 2002, we all taught people that the market returned 12% average. Couldn't guarantee it, but that was the average. If you put your money in long enough, you put in like $100 a year or $100 a month for 40 years at 12%, you'll be a millionaire. What I failed to tell people is that one, the market does not return 12% per year, especially over 40 years. Two, how many of us really want to be working for an extra 40 years? Some of us may not even have that long. And then three, guess what? A million may not mean much in 40 years because of inflation and everything else. And so I've realized that if you want the typical traditional retirement goal of if you want to have like a $60,000 a year lifestyle, you got 20 years to retirement, you probably need to be saving about $8,000 to $10,000 a month if you want to factor in inflation and real rates of return in the markets and everything else. And so I'm not about teaching you how to accumulate your money and save it for the long haul like every other financial person out there is teaching. This is where I'm an anti-financial advisor. I teach you how to create cash flow now, how to create that today. And this is about acceleration, about really ultimately creating leverage quickly. And I've been able to do it in my own life. I remember in 2006, I was able to leave. I quit being a financial advisor because I couldn't be in integrity teaching something that doesn't work. But as I started to associate with people that were millionaires and had already done it themselves, I myself was able to retire in 2006. And it did not take a lot of money to do that either. The key is cash flow, creating streams of income that do that. And this is where the rubber really hits the road. And I've been able to do it again. I've been in the worst too. I even went through a recession. A lot of my real estate got hit hard. I went from millionaire to upside down millionaire and then battled back where over a year ago, I was able to get to the place where, again, I had residual and passive income streams that got me to retire once more. And now I'm teaching this because it's freaking fun. And I feel like the more money I make, the more I have a responsibility to teach you. And so that's where this comes into play, is that I don't want you doing the same old stuff that hasn't worked for years. And I know I've been in the financial industry for 16 years, and I can tell you that you cannot save your way to wealth. It requires doing it differently, doing the opposite, doing the same thing that banks have done for generations. But they've been teaching us to do it the other way. And that's why that's why in 2006, I had to quit being a financial advisor, doing the traditional old stuff that I had done, because I'm telling you, like, that method does not work. And it's just taught you by financial institutions and advisors and people like that are so-called experts that are basically paid by these institutions to tell you how to do what works best for them, but not necessarily for you. And so I don't want you in that place. And people don't get it. And what I'm about to teach you today, some of the biggest talking heads out there don't understand this. They don't get it. They're not that big. They just go with one thing. Usually they get stuck on teaching one thing, like, hey, be debt free. Debt is evil. It's always bad. You know what? That's because they sucked at it. That's because, some of them went bankrupt trying to, go into debt, doing it incorrectly. But in their own personal lives, I can tell you, some of them actually use it differently. And a lot of them use these very strategies. They just don't teach it to the public because they don't think you can handle it. And I'm here to tell you that with the right education, the right training, and the right principles, it's a piece of cake. So I'm teaching one strategy. I'm not going to teach you how to like create passive streams of income in this particular training right here, because this has a little bit different focus. I teach that in other trainings. But what I want you to teach you is really a key thing that even those that understand, even if you've been taught and maybe you're even implementing, you've been creating passive income for yourself, this is going to give you that extra little edge, the extra little boost to be able to get you just a little bit more and be able to do this with no extra money out of pocket. So what I'm teaching you, it's totally different. Banks have been using this strategy for years. This strategy we're talking about using is using the whole life insurance policy. Now, the thing that's different between what I teach and what everybody else teaches is that most insurance agents are taught to do it from what the bank wants you to do. Same problem. Institutions want you to do it a certain way. This is not that way. Most of them, like for example, you put in money, you put in, say it's $10,000 for the next 17 years. Hopefully by that point, you will have $170,000 in cash available to you. Whole life is great because it covers you your whole life. The premiums don't go up over time like term insurance does. In fact, by the time you're turned 77, you've already paid your entire death benefit when you buy term insurance. But with whole life, you pay that one premium the whole time, just like when you're paying a 30-year mortgage. Yeah, it might be more expensive than it is to rent, but over time, you know that a mortgage is going to be way better than renting and having that rent go up on you every year or two to adjust for inflation. And so whole life does the same thing. Now, by itself, if you do it the traditional way, it's not that bad. It does cover what you need with a death benefit. But I'm not here to teach you how to have a death benefit. I'm here to teach you how you can get your money to make money twice, to create more leverage. And that requires a very different philosophy, a very different way of looking at things, doing it differently than how insurance companies are teaching you to do it. And for me, I learned this over the years. I actually was sold a traditional whole life policy that I would agree with guys like Dave Ramsey who say that whole life's expensive. It is. I was sold the traditional thing, and I asked up front if there's ways to create more leverage with it, and I was told no. Later on, about 2009, I found out you actually could and do it very well. And I remember confronting this guy about this agent that had sold me this expensive policy that I lost during the recession because I couldn't keep paying the premiums. And I asked him about it point blank, and we went over numbers. I showed him numbers because obviously I've been insurance licensed for the last 16 plus years. I showed him the numbers, and I finally said, "Hey, you have no good argument here. Why did you sell this to me? Why are you selling this to everybody, even the clients I've referred you?" And he said simply, "It's because I can't afford not to." He's like, "Because it's for my commissions. Like I don't want to cut my commissions back." Well, guess what, guys? There's ways to do whole life where I can minimize the fees as much as I legally can while keeping it tax-free and allowing more cash to grow. And so I'm going to teach about that here today. So how do we make money twice? That's the real question, right? This is the important concept you got to understand. There's always two options when it comes to using money. You either just use the cash you have in savings or you borrow it. Pretty simple, right? Either use your own money or you use somebody else's money, right? Now, obviously, from a leveraging standpoint, if the numbers work out right, leveraging other people's money is the preferred way to go, especially if you're wise and you're a wise steward with the money. But, a lot of times people say, well, if I borrow it, then I'm paying an interest rate. And that's very true. But did you know that there's also an interest rate that's costing you as well if you use your own savings? And you probably think, wait, well, how is that true, Chris? Well, easy. The cash that you use, when you liquidate a savings account, for example, to go and invest, you've now lost the ability for that money to earn money in that savings account, right? Because you just pulled it all out. So there's no money in there to grow. It can't compound and grow. Now, granted, you probably put it in a better place where you could, say you put it in a place where you bought investment property. Well, that investment property, yeah, it's paying you cash flow. So hopefully that's going to pay you more than the bank. It better, or you shouldn't be doing that property. But it's probably going to be paying you a lot better than what the bank will pay you, right? So yeah, you're making money in one place. But what if you could have that money still stay in savings and use all that money from that savings to go and invest in that property? So essentially the money's still growing in savings, earning compound interest, and you're still earning the cash flow from the property. Now, wouldn't that be cool? Sounds too good to be true? Guess what? It's possible. In fact, I've done it before. So I've even used strategy with a normal bank. But the strategy I'm going to teach you here with how we use life insurance is going to be way better than what I even did with the bank before. But yes, you can have cash growing and accumulating. But here's the cool thing about life insurance is it can grow tax-free. You can earn much better dividend rate than what you get from the bank, way better. And of course, you got liquid access to it, just like you would with a savings account, but you can have the leverage to make money twice. So let me talk about some ways that that's possible. Like I said, you're always paying interest, whether you borrow money from somebody else or you spent the money and you've lost the opportunity to earn interest. That's that lost opportunity cost. So compound interest versus simple interest. Let's talk about this right here. This is the key component to making this work. This is why this strategy works so well. So let's just take a mortgage. Say you get a $200,000 mortgage. If you got a 30-year mortgage at 4.5% interest, so 4.5% interest, over those 30 years, if you pay the minimum payment, you will pay a total of $164,000 in interest over the life of that loan over those 30 years. So you pay almost double. Now many times people might say, "Ugh, I don't want to pay that $164,000. Maybe I'll just pay off the mortgage now. I'll just pay cash for it," which you could. If you paid cash, then you guarantee you save yourself $164,000 over the next 30 years in interest. I'm not talking about principal, just the interest, right? But what if you didn't pay off that mortgage? What if you said, I could pay off that mortgage if I liquidated all these different assets and everything else I could do? What if I just cashed out everything I possibly could, sell off all my stuff, and that $200,000, I just pay off my mortgage now? Well, your best case scenario is obviously you're going to save that $164,000 from day one. That's your best case. Now, if you're talking about putting like a little bit of extra, paying down a little extra principal every month or year, that's not going to do much. You're not going to save a whole ton of interest that way. So your best case scenario is saving the $164,000. But what if you just said, but that mortgage, I won't. Even though I have the money there in savings, I've cashed out everything. I could liquidate everything, but instead, I'm not going to pay off my mortgage. I'm going to let that $200,000 grow. And maybe you earn it at a certain savings. So let's just say that you took that $200,000 instead of paying off your mortgage over those 30 years. Instead, you let it grow in a savings account for 30 years. And say this is in a nice little CD, right? At 3.5%, which I've actually just started to see CDs get up to about this point. So 3.5% in a CD over the next 30 years. Now, if you pay $164,000 at 4.5% interest on a mortgage, how much do you think you'll earn on 3.5% on $200,000 over the next 30 years? So your $200,000 is growing at 3.5% per year for the next 30 years. What do you think you'll earn? And just kind of think about that in your head a little bit. Now, most people will say, well, if it's $164,000 for 4.5%, and if I'm only earning 3.5%, so I'm 1% less, it's probably less than $164,000. So I get numbers that vary all over the place. Some people might say $120,000. They're just trying to do it proportionally or whatever it might be. Some guess more or less. So whatever your guess is, here's the number. $200,000 over the 30 years at 3.5%. The number is not $120,000. It's $361,000. Now, wait a minute. Didn't I just say that you paid $164 for 4.5%, but only 3.5%, you earn $200,000 more? Well, how's that possible if you're earning less interest? This is the power concept here. Because remember, these are not the same interest rates. The 4.5% mortgage is what's called simple interest. As you pay down principal and interest on that mortgage, you're paying less and less to interest and more to principal, right? Think of like car loans or any other loans you've had. The more you pay down the balance, the less interest being charged, and therefore more of your payments going to the principal, right? Same thing with your mortgage. It goes down over time. The curve goes down. But the opposite is true with compound. It goes up. So that if you look at the blue area, the blue would be like, oh, cool. Yeah, this is going down. I'm losing money, right? Or essentially I'm paying less and less interest over time. But there's an upward curve because from that 200,000, it's growing and growing exponentially because that 3.5% on 200,000 means you made $7,000 that first year. But now you're earning 3.5% on $207,000. So now you earn a little bit over that $3,500. Now you're almost $211,000. Now you're earning 3.5% on 211. It just keeps going like that snowball, but in a good way. So it grows over time. By the way, key point, if you earn even just the same interest rate at 4.5%, you've now earned almost $500,000 in interest. So you're just blowing it out of the water if you even just earn the same interest rate. Now, why is this so important? Well, one, this is very important because if you're debating about whether to pay off your mortgage or not, you might want to think again, even car loans and things like that. If you can earn more than what it's costing you in the interest, and if, as you've just learned, you don't even have to earn the same interest rate to beat it. By the way, key point here, if you want that 4.5% mortgage to beat it, you need to earn about 2.15%. If you earn at least 2.15% on your money over the next 30 years, you will match the amount of interest you paid at 4.5% on your mortgage. Or a good rule of thumb is, as long as my interest I'm earning is at least half of whatever the interest rate I'm being charged, I'm winning. And that's typically true. Even a 5-year car loan, it's about half. So you have a car loan at 4%, you just need to earn 2% to break even. If your loan is at 8%, you need to earn 4%. If it's at 10, you need to earn 5%. Anything above that, that's where you win. Now, why is that so important? Because that's exactly the concept we use with life insurance. Now, see, what we're doing with life insurance, we're basically just borrowing from the cash you already have. But the insurance company is actually giving you a loan. This is the same strategy I did like I mentioned earlier, with my savings account. I remember I had $25,000 just sitting in savings, doing nothing, earning 1.5%. This is back in 2007. I was earning 1.5%. And I remember I went to the bank. I started getting creative. I thought, hey, Mr. Banker, could I do a line of credit, or could I do a loan against the savings? Leave the savings in there, but do a loan against it? And the answer is, well, of course you can. We call that a secured line of credit. I said, cool. Well, what's that look like? And the banker said, well, based on everything here, yeah, you're earning 1.5%, but we'll charge you 4% for this loan. And basically it's like $225 a month for that $25,000, which I thought was a screaming deal, because I thought, hey, I'm leveraging 25 grand for only $225 a month. Not bad. Even with an investment property, I could still make a little extra money, extra cash, and I would use no money. I'd still have my money there. Now, my money, the $25,000, was still growing at the 1.5%. All of the money was still in there. They were just giving me a loan because they knew, hey, worst case scenario, if you can't pay the loan, we just take the money out of savings, right? There's no risk for them. And ironic that they charge such a high interest rate. 4 is not that high, right? Especially back then. That was like dirt cheap back then. Right now, you could probably do it for about 3% or so is the current loan rates currently in 2018. So anyway, it's like, hey, that's pretty good. So I did it. And eventually just paid back the loan, right? You can do the same thing with an insurance company, but the nice thing is, as opposed to what I did with the bank, this doesn't show up on your credit. And all we're doing is we're taking the money from your savings, we're putting it into this high cash policy. So we're taking the money from your savings, putting it in the high cash policy. Most of the money is in there. In fact, in the first year, you'll have, depending on your age and health, you'll probably have at least 75 to 80% of the cash you've put in that first year. So, if you're, say, for example, you put in $40,000, you're already paying for the insurance costs and everything else, of course. But instead of having zero the first year, which is what most normal policies have, by the way, the normal policies, the first 2 years, if I put in $40,000 a year for 2 years, I'd be lucky to have about $1,000 after 2 years, after putting in 80 grand total. Doing the way I'm talking about here, although you put in 80 grand instead of $1,000, if you're lucky, or right about there, it's usually about $1,000. Instead, you're going to have probably in the ballpark of at least $65,000. That's huge. That's awesome. To have $65,000 instead of $1,000 is a big deal. Usually most insurance policies will, like I said, take you 17 years to break even. So if you put in $10,000 a year for 17 years, you should have finally saved up about $170,000. In this kind of policy that I have you set up, instead, you're going to have at least 75%. So you put in $40,000, and that first year, in fact, within about the first month of it being set up, you can access $30,000 of it. Now that money's still there; it's still growing. But the difference is, now we take a loan from that policy. So say you did put in, you did the $40,000. There's $30,000 there to leverage. You now go and borrow $30,000 from the insurance company. Now that $30,000 can be paid back however you want. It's not on your credit report, like I mentioned, but there's also no required monthly payment. They do charge you interest. So say that the interest they charge you is 5%, but at the same time, they're also paying you dividends of right around 4%, give or take. So yeah, there's still the spread, But as you already knew, as long as you're earning at least 2.5%, you're winning. So this is where it's cool, because we're taking the money out of the policy, putting it into the investment. So say you buy that investment property, you have the cash flow from the investment property, you pay it back towards the policy to pay down the loan. And by the way, every time you pay down the loan, just like when you pay back a home equity line of credit, you can use that money again. You could turn right around and do it again. There's no limits to number of loans you can get. You can do all you want. And so you're taking the cash flow from the investments, paying it back towards the policy loan, and then it just keeps cycling through. At the same time, you're earning dividends, tax-free dividends, by the way, from this policy. So like I mentioned, it's tax-free. By the way, this is also protected from creditors and lawsuits. And in most states, it's very protected. It's like 100% protection. But this is better protection than even you get from a savings account, by the way. If you get sued, they can access your savings, no problem, in any state. But here, in most states, you could be a millionaire and somebody sues you, they can't get to any of this money. In some states, they might be able to get to a limited amount of money, but still there's at least a pretty decent amount of protection that they cannot touch no matter what. The only people who can touch your money, and any money you have for that matter, is the IRS, because they can get to anything. But other than that, this is just as protected. This has as much protection as like a 401k. The difference is it has guaranteed growth. You don't have all the market swings. It's guaranteed to grow, even if they don't pay a dividend. Which, by the way, one of the companies I like to use that gives you this higher cash value type policy, a company I like to use has been paying dividends straight since 1847. So they've kind of had a good track history of at least paying a dividend. But those dividends can range, like the gross dividend right now is around 6.3%. But the key on that is not even the dividends. The key is really how much cash do you have growing in this policy? How much can we make the insurance costs cheaper so that you have more cash growing in there? That's the real art behind the science here. So like I said, tax-free, protected from creditors and lawsuits. It's guaranteed growth. It's private, so there's no credit check. There's no effect. I mean, somebody asked me this morning, they said, well, how soon can I get to the money? Well, if you make the request this morning, say it's like a Tuesday morning, you can easily have it by early next week. Like the check actually in hand, like in the mailbox then. Or you can even do ACH drafts where within about 3 to 4 business days, you can have it in your bank account. So lots of ways to access that cash very quickly. So usually within about a week, you can have access to that cash right away. And like I said, you don't have to wait years for this to grow. I mean, even the people that are out there teaching you how to be your own banker and things like that, most of the time they're talking about doing that 5 to 10 years down the road or more. I'm telling you how to do it like next month. So, I mean, after you go through maybe a month or two of underwriting, after it's all set up and funded, the next month you can access the cash. So in about 30 days, you can get access to this money. So if you have an investment you're planning to do in like say 3 months from now is the time to start applying for it so you can actually get the cash in and pull it right back out. And like I said, like you got dividends, you got cash flow investments. So your money's not only earning dividends in the whole life, but now you're also earning money on your investments like you would normally. So now you're making money in 2 places at once. Like I said, this is where it's like a supercharged savings account. I even did an example. A guy he was doing $500,000 a year. He wanted to know what it would look like if he did a max loan. And so in his case, his max loan that first year was about $380,000 or so. And so I showed that. I said, all right, let's take that $380,000. We used the example of putting in a fund that we both knew that paid 1% a month. And that means he was getting paid $3,800 a month, right? So we're like, cool, we'll take that $3,800 and apply it back to the loan. Now, of course, before the loan was even fully paid off, it would take about 9 to 10 years, right? That didn't matter. The thing is that he's still earning compound interest on that money. Plus, he's now getting that money back in the loan, even if he did nothing else. And by the way, you can have multiple loans out. There is no loan limit. You could take out multiple loans all at the same time. This is not like a 401k where you're limited to just one loan at a time. You have to pay it off before you do another loan. This, you can actually do, you can have 10 plus loans outstanding, and that's not a problem. As long as the cash is in there, you can do a loan. So anyways, we did the numbers. What we found out is that for him to get the same thing, so just like liquidating from savings and then paying the cash flow back into savings to build it up slowly over time to eventually get some compound interest, right? We did the comparison. He would have to earn 5.5%, 5.5% return on a savings account to match what he was going to get with the whole life policy that we're using. which, as we all know, sorry, that doesn't exist. And that's based on today's numbers, right? I mean, this is where you guys are maybe earning point nothing percent on your savings account and getting taxed, by the way, on that point nothing. So for him, with his tax bracket and everything, you have to earn 5.5% on a savings account to match this, or he grows it here. And so, yeah, this policy was growing, tax free, just about, in his case, just about 4% a year net over that period of time. And he was still making money on his investments. So what does that look like? Here, let me show you an example here. Say you got $95,000 you borrow from your policy to, and these are with real properties, by the way, with real numbers, a single family home as well as a duplex. So I took these two different things here. One was like in Tennessee and the other was in, I think it was Oklahoma City. And $95,000 down, the net cash flow after all expenses are paid, property management fees and everything, was $1,070 a month. So what we would do is, okay, we'll borrow $95,000 from the policy, take the $1,070 and pay it back towards the policy. So the question is how much more interest would we earn on that than versus earning like 0.2% on a savings account? I was being a little bit generous on the savings account, obviously. So 0.2% on their savings account. So we did the comparison. Here's the difference right here. The net gain in just 10 years on the whole life gain, an extra $21,000, another 22.5% ROI on that same $95,000. Guys, right there, that $21,000 just 10 years, that's like another down payment on a small property. So, I mean, the key is here is that, yeah, you're doing the same thing you're doing with your savings account, same thing you're already doing, but now we're flowing through this policy and boom, now you're earning like $21,000. And it's awesome. I mean, over 20 years is even cooler. So that's the key, guys. Is like, it's, I'm not going to get too complex with this, but the important thing to know is this, is that you can access 95% of whatever cash is in there. I even have this too. I funded a policy last year doing the same thing. I was holding it for a down payment on my own house. You can hold cash reserves in this. You can, you can even pay your like annual payments with this kind of thing, whether it be annual taxes. You can put the money in, pay the taxes, then use the money you're saving for the taxes to pay it right back in and do it again the next year. But now at least you're earning some money versus, putting your money into a savings and earning nothing, right? You do that with that. Insurance premiums. I have one person that they got one policy for themselves to do investing with, but then another policy on their spouse to then use as like an escrow account to basically pay their annual expenses like taxes and insurance premiums and things like that. Even people are using this to do college savings plans. And so you can even set up policies on your kids. Because, hey, if your kid doesn't go to college, you have a 529 plan, you're up the creek. You're going to get penalized on that money and taxed because you took it out to use it for non, qualified purposes. Where with this insurance, you can use the money whenever you want. And now you're using it tax free too. And so if they decide to do some vocational training instead or open up their own business, great. You can be flexible with that. By the way, you can own and control a policy. Your kids don't even have to know they have it. And then down the road, you can even gift it to them later on and say, hey, here's your wedding present, or here's for your down payment of your first home, or whatever it might be. Again, the imagination is the limit. I had somebody that asked about doing triple dipping on this, not just double dipping your returns where you earn dividends and you're earning investment money too. But they said, hey, couldn't we could we use like a credit card with points on it or a rewards card? Could we use something like that? Use that and then pay it off, and so we're not getting charged the interest on the card and do that kind of thing. And my answer was, well, yeah, you could technically. Yes, you could. I mean, you wouldn't pay the premium with the credit card, at least not with some insurance companies. But if you can get that cash out, get into your normal account, and then from that account, then go and pay for your policy premiums, and then right there, take the money back out like within 30 days and pay off that credit card, and then you just fill up that money back in again. Now you've earned rewards points on your card, so you're earning money there, and you're doing the whole leverage aspect too. You're leveraging it and using it however you want. So the answer is yes, you could definitely do it that way. So lots of different ways you can go and create, cool stuff. Another cool thing too is you can get multiple policies on yourself. You don't have to just get one your entire life. Say you got 3 or 4 over the course of your lifetime, and down the road, let's just say you're like, hey, I've got plenty of policies for my kids, but I'm a little short on cash. I'm 85 years old. What do I do? Well, let's say you take 1 or 2 of those policies, you can put on the marketplace, sell it to investors that hope you die tomorrow, And say it's like $1 million policy, for example, you want to sell off, depending on how the policy is and your age and everything else, let's say, hey, for that $1 million policy, we'll pay you $350,000 or $400,000 right now. And so they pay you the cash right now. You get that money to use up today, and then they get the life insurance. They're the beneficiaries on it. If you die tomorrow, they made bank because they're like, cool, I just made $1 million off of 350 or 400,000. If you die in 10 plus years, they still make money. And so it's so cool. It's just like real estate in that way. Like you're actually buying properties in a sense when you buy life insurance. So many cool ways you can use this, more than I'm going to go into here because I don't want you guys to get bored and turn this off. So anyways, I'll leave it at this, is that this is the strategy I use. And the thing I guarantee is that I'm going to try to get the most cash in the policy possible while keeping it tax-free. That's the one thing that I do. Even if somebody says, hey, I got quotes from another guy, cool. All right, we'll see if I do better. If not, I'm like, go with the other guy. In fact, if the other guy can do it better, I want to know how he did it so I can then duplicate it and do it better myself. So either way, the one thing I guarantee is that I'll at least match, if not best, anything that somebody's trying to show you. And the cool thing is this is all guaranteed. There's not speculation. This is not like index universal life insurance or variable universal life where you're hoping and praying that the market does it just right. But if it doesn't, which I've experienced, I used to sell these in the early to mid 2000s. If it doesn't work out just right with all those increasing costs and everything else, you can actually lose money in those things. Here you can't. So there's not all the guesswork. It's the hardest part about this is that we make it so flexible, and you can do so many cool things with this. There's no max, by the way. That's the flexibility too. Like a Roth IRA, which is similar tax structure to this. Roth IRA, you're locked in about $6,000 a year you can put in. Here, the more money you earn and the more you qualify for insurance-wise, the more we can stuff in these policies. Like I said, I've had people stuff in anywhere from, a couple thousand, $5,000, $10,000 a year. And in most cases, if you can do at least $15,000+ a year, you really get like the max ROI on these things, depending on your age and health rating, of course. But I've done well over $500,000 a year too. So there's so much flexibility, and again, have all the tax benefits too. Even if you didn't use this for investments, this would still be a great tool to use to store cash and have available, that that you wouldn't lose money in. You guaranteed growth all the time. But the fact you can double dip and use it for your investments makes this a no-brainer. It's just freaking awesome. So this stuff I do for myself, this is things I've had my clients do. And it's what I recommend as well. I don't recommend the traditional crap you've been taught for years about doing life insurance. This right here, this is the way I like to go. This is the way I like to go because now you make the biggest bang for your buck. And I love it. This is the thing I love. And like I said, I've been retired for a while. This is just fun for me, and be able to see how you guys get excited. And I love the referrals you guys have been sending me too. So anyways, that's how this works. That's how we can create the returns. Who's this not for? People it's not for is those. I had a guy who's well in 300-400 pounds. He wasn't going to be able to qualify well. He was in really bad health. Wasn't for him. It was for his wife though. So we ended up getting a policy on his wife instead. I've done on kids, like I've mentioned before. So it's not for people that, again, are in bad health. Also, if you're paycheck to paycheck, like you're strapped for cash, I'm probably just going to recommend having you do a convertible term policy that we can convert later on when cash isn't so tight. So I wouldn't say doing whole life when money is tight, when you don't really have a lot of money to save. But if you're saving at least, especially if you're saving at least $10,000 a year into your own savings, or two, you've got at least $50,000+ sitting around in savings, you're wondering how to get to be better leveraged, this is a conversation we need to have. So like I said, why wouldn't you use it? This is a no-brainer. If you do this and you structure it right, like again, most agents won't do it because they won't cut their commissions back to do it. But I'm telling you, if you do this right, it's awesome. And it's a no-brainer. So anyways, thanks so much for you guys' time today. If you've got questions, reach out to me. You can email me, chris@moneyripples.com. That's CHRIS @moneyripples.com, and say, hey, Chris, I've got some questions. I would love to know how this works in my situation. What would the numbers look like? Reach out to me. Let me know, and I'll be able to do that for you. So hope this was really educational. Hopefully you learned something that just blew your mind, because I'll tell you, it blew mine. And that's even after I was in the insurance industry for years. But when I really caught the full value of this, man, like I said, it was a no-brainer. This is why I do it. This is why I have everybody else to it. And I create these policies just like I create it for myself. So anyways, thank you so much. Have a wonderful time. And again, like I said, have a prosperous time. And I hope to talk to you later. We'll see you.